difference between business free cash flow, savings, investments, and insurance. Introduction. In today's dynamic economy, managing your business finances goes beyond simply tracking income and expenses. It's about knowing how to allocate surplus cash, when to save, what to invest in, and how to protect your assets with insurance. Understanding the differences and interactions between free cash flow, savings, investments, and insurance is essential for making smart financial decisions. In this video, we break down these concepts clearly and practically, drawing from both Kenyan business realities and international practices. What is business free cash flow, FCF? Free cash flow is the money your business has left after paying for its operations and necessary capital investments. It's calculated like this. FCF equals operating cash flow, capital expenditures. This is the cash available for reinvesting into your operations, paying off debt, distributing dividends, or building up reserves. A Nairobi-based construction company, for instance, might use its FCF to buy a new cement mixer or reduce bank debt. Why free cash flow matters? It gives your business the flexibility to take advantage of new opportunities without relying on loans. A positive FCF means your business is generating real value, not just recording profits on paper. This financial strength makes your business more appealing to lenders and investors. A fast-growing Kenyan agri-tech startup with steady FCF can attract international venture capital more easily. How to calculate FCF, an example. Let's break it down. Operating cash flow, $400,000. Capital expenditures, $100,000. Free cash flow equals $400,000 to $100,000 equals $300,000. That $300,000 is available for savings, investment, insurance premiums, or expansion. A retailer in Eldoret might use part of it to restock inventory and the rest to refurbish its shop. What are business savings? Business savings are profits intentionally set aside for future use, not spent, not invested. They create a financial cushion that can be tapped during economic downturns, emergencies like equipment breakdowns or natural disasters, unexpected opportunities requiring quick capital. A furniture-making business in Nakuru could build savings to survive a seasonal drop in sales or handle machinery repair costs. Savings versus free cash flow, what's the difference? Free cash flow is the available cash after essential spending. It's a measure of surplus. Savings are what you decide to keep out of that surplus for future protection. FCF is about potential, while savings are about security. A business could have $500,000 in FCF and decide to save $100,000 while using the rest for investment and insurance. What are business investments? Business investments involve using capital to acquire assets or enter ventures that generate long-term income or value. These can include internal investments, upgrading systems, expanding branches, developing new products. External investments, purchasing shares, acquiring another business, or venturing into a new market. A Nairobi-based poultry processor might invest in cold storage facilities to scale exports to Rwanda. Evaluating business investments. Before investing, ask, what's the expected return on investment, ROI? What are the risks and potential losses? How long until returns materialize? Example. Invest KES 1 million in automated machinery. Expected gain, KES 500,000 per year. ROI equals 500,000/1 million times 100 equals 50%. That's a strong return for most industries. What is business insurance? Insurance provides a safety net when things go wrong. It compensates your business for losses or damages to essential assets. Types of insurance include property insurance for buildings and machinery, liability insurance to protect against lawsuits, business interruption insurance to cover lost income during downtime, cyber insurance to protect against data breaches and cybercrime. A Nairobi-based law firm might secure cyber insurance, while a Kiambu dairy plant opts for property and interruption coverage. Why insurance is critical. Insurance shields your business from catastrophic financial losses. It ensures you can recover and keep operating even after serious disruptions. It also gives confidence to investors, lenders, and customers who see that your business is well prepared. Globally, most companies are required to have liability and worker coverage by law, and increasingly, cyber insurance is becoming non-negotiable. Comparing savings, investments, and insurance. Here's how they differ in purpose and function. Savings, emergency funds, protect cash flow. Investments, grow the business, boost profits. Insurance, manage risks, protect assets. In practice, a Nakuru logistics firm might save for fuel and repairs. Invest in route optimization software. Insure its fleet against accidents. How cash flow, savings, and investments interact. Free cash flow is the starting point. You decide what to do with it. Put a portion in savings for security. Use another portion for investments. Use some for insurance premiums to protect what you've built. These decisions keep your business both resilient and forward-looking. Strategic financial planning. Striking the right balance is key. Grow through investments. Stay liquid with savings. Remain protected through insurance. A Nairobi-based IT firm, for example, might allocate FCF like this. 40% into a new data center, investment. 20% into cash savings. 15% into insurance. 25% towards scaling marketing campaigns. Common financial mistakes to avoid. Neglecting savings leaves you vulnerable to cash shortages. Overinvesting ties up cash in risky ventures without a fallback. Skipping insurance exposes you to massive losses from theft, lawsuits, or disasters. Poor planning results in misallocation and financial strain during crises. Case study: smart allocation in practice. A Nairobi-based event planning company generates KES 3 million in annual FCF. KES 1 million reinvested in event tech. KES 500,000 saved for off-peak season. KES 1 million invested in regional marketing and training. KES 500,000 used for comprehensive insurance coverage. This blend ensured the company could grow, stay liquid, and remain protected during COVID-19 disruptions. Key takeaways. Free cash flow gives your business the fuel to plan ahead. Savings provide safety. Investments drive expansion. Insurance protects your foundation. Together, they form the core pillars of financial resilience. Build, protect, and grow. Your business doesn't just need profits. It needs a strategy to grow wisely, protect what matters, and survive the unexpected. So, plan with clarity, allocate your free cash flow with purpose. In Kenya, Africa, and the world over, businesses that manage their finances with balance are the ones that last, thrive, and lead. Thank you for watching. Stay prepared, stay secure, and grow your business with confidence.